could serve as a longer-term buying opportunity given the likelihood of a soft landing. Let's bring in Jim Caron, CIO of the Portfolio Solutions Group at Morgan Stanley Investment Management. Jim, welcome. It's nice to see you.
Good afternoon, Scott.
Bull trend intact. Why?
Well, the way that we see this is that we've had a pretty significant earnings decline first quarter, second quarter, and the third quarter is on the same path. If we believe, which we do, that we're going to avoid a hard landing and we may have a mild recession, soft landing, however you want to categorize it, this could serve to be the inflection point where we start to see more of a broadening of the breadth and you start to see an increase in earnings potential as we move into 2024. Now, for sure, I do expect that we are going to see a mild recession. It could come in the first part of 2024. It could even start late this year. But the point here, though, is that I think that the broader parts of the markets are already anticipating this and are reasonably priced for it. So as we start to roll the clock forward and as we start to think about this inflection point, if we avoid a hard landing, then if we start to see, in my view, another 3% or so decline in the overall level of the equity markets, that this becomes a very, very nice spot to think about what could be more, closer to $240 earnings at about a 19 multiple. And you could see levels of the S&P up closer to 46 or even 47 or potentially 4,700 or potentially higher.
But couldn't I also say if you lay out your case that if you think there's going to be a mild recession, that would suggest that earnings haven't troughed just yet, which would then suggest that the market's not potentially as quote-unquote reasonably priced as you just suggested it was, because the implication being that even weaker earnings potentially couldn't possibly be priced in.
Yeah, no, look, that's a good counter-argument, and it is a two-sided risk here. We think, though, that the asymmetry is still to the upside because effectively people are, I would argue, more underinvested in the equity markets. Now, most people came in this year more overweight bonds, more thinking about fixed income and less on the equity side. And the recent couple of months has caused some shift in that sentiment and some shift in that narrative. But I would argue that there's going to be more support in terms of buying on the downside than there will be selling because on the upside, because people aren't already too long at this point. So if the markets were very overextended long, then I would agree with you, Scott. But to the extent that I believe that I don't think that's the case, I think that the markets are still underinvested in equities, that essentially that dip buying is likely to be more dominant, and that's more supportive. So really what I'm looking at is an asymmetric profile, and I think that the asymmetry still leads me to believe that there's going to be more aggressive dip buying than rally selling.
What about the backup in yields and what that potentially means for your projections on where we might go? If yields, which have, they're up, 50, 60 basis points since earnings season really began, if they remain higher now for longer, what's the upset to what you just said?
Yeah, well, I mean, it's really a question of the Feds. How high are they willing to take these rates? If we do get this slowdown, which I think that we will, this is actually good news for the Fed. It actually tells them that they don't have to hike interest rates. So what I'm concerned about on the rate side is if the Fed sees that we're having too frothy growth, or if the markets aren't correcting, particularly the equity markets aren't correcting, and that brings them in to hike even more than what people are anticipating right now, then I think that would be very, very bad news. If they start to fall behind the curve of inflation and start to see that inflation is unanchored, that would certainly be very, very negative, because then the sky's the limit on how high they can hike interest rates. But if we see this slowdown, which I do think we're going to get, we are seeing a slowdown in the data, then I think that they stay higher for longer, but they pause. And I think that pause in and of itself is actually somewhat positive for the broader equity markets.
I've been asking everybody, so I'm going to ask you as well, because we're thinking so much about NVIDIA's earnings tomorrow and overtime. The importance of that report at this particular time especially is what?
Well, look, I mean, it's clearly important. It's very, very much a headline stock that's out there. We don't play it from a stock-to-stock perspective. I would say that it would maybe make people rethink growth. But from my perspective, the growth sector, from my perspective, I think the opportunity is more in the value sector. So to the extent that growth has a correction, I think value is a beneficiary. So I think it's significant, but I think it's significant for different reasons.